My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now.
Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. I'll be with my friends. I'm just trying to make a little money. My job is not just to entertain, but to explain days like today, tell you how they work. Call me 1-800-743-CNBC. X me at Jim Cramer. Can one man create $21 billion in value on the first day on the job as CEO? That's what happened at Starbucks today when they dismissed Laxman Narasimhan and hired Chipotle's Brian Niccol as the new CEO. Look, this is an amazing development. Even on the day where the Dow gained 409 points, S&P jumped 1.68%, and then Nasdaq pulled on 2.43%, largely thanks to yet another tame inflation number. The benign producer price index caused bond yields to fall, creating a tremendous backdrop for the stock market, especially, yes, the tech part of the Magnificent Seven. Look, on a normal day, we talk about the stellar gains in the Mag 7, including Alphabet, which we heard after the close might be pursued for a breakup by the Antitrust Division of Justice. I see this one feels a lot like the breakup of Standard Oil, which created more value than anything the Justice Department has ever done. Now, but this is not a normal day, people. Today, we got something very rare. A CEO was straight up fired, and in his place, we didn't just get some stuffed shirt we didn't care about. No, Starbucks brought in Brian Niccol, the man who almost single-handedly turned around Chipotle to run the business. They could not have picked a better guy. The market clearly agrees, with the stock up an astounding 24.5%. I was blown away, and I know all the characters. Now, we know Chipotle's stock only lost less than $6 billion on Niccol's departure. They got a big bench there. And Jack Hartung, one of my favorite CFOs, has agreed to stay on in what seems like an expanded role. He's going to retire next year, while Scott Boatwright, 7-year veteran, will take over as CEO on an interim basis. Brian's a remarkable leader, innovator, pitchman, and throughput expert who happens to be one of the funniest and yet most rigorous CEOs I know. I've had the privilege of spending a lot of time with him over the last 6 years. And when I heard he got the top job at Starbucks, I was thrilled, both for him and, more important, for the shareholders, including my charitable trust. We will be talking about this position tomorrow. We got a 12 o'clock noon meeting. You got to be there, okay? Just sign up for the darn thing. But let's go back to the oddity of a CEO getting fired, only to be replaced by someone better, which is very hard to pull off and usually doesn't happen in corporate America, where it's almost impossible to fire people because you got to pay them so much money. Now, I had high hopes for Laxman when he started the Starbucks job. He trained at McKinsey, one of those amorphous consulting firms. Then, after a successful stint at PepsiCo, he got the job at Reckitt Benckiser, another consumer products company over in England. It seemed like a pretty good resume. However, the problems that he inherited were simply too big for this well-meaning executive, cut more from the McKinsey cloth than from the barista apron. The company needed a fast food executive who understood the elusive goal of throughput, getting fans of the food in and out before they turned ex-fans, as has been the case of Starbucks of late. To wit, at one time, Starbucks was widely regarded as what we call the third place. It's a brilliant idea from the creator, now chairman emeritus, Howard Schultz. How many of us used to love to sit and read at our Starbucks, taking a break from the office or the home? Have you tried lately doing something like that at Starbucks? You can't. The place is a madhouse. Yeah, it's that relaxing to go to a Starbucks. Starbucks used to have a reasonably priced cup of coffee. It was never cheap, but it wasn't extortion either. Those days are long gone. Starbucks used to have enough people behind the counter. You didn't have to wait that long for your coffee. Now the lines are longer, and the people keep cutting in to get their mobile orders. I don't know about you. I get furious at this process. Wait times are both long and inconsistent, the worst possible combination. Now, Starbucks has allowed some companies to license this brand, and they have done a horrendous job at it. Starbucks should go after whoever runs these franchises in the airport for failing to staff and turn the lifelong supporters into enemies. That's what they're doing. You just want a decent cup of coffee at the airport, you end up with a long line and mosh pit of waiters. Everyone knows it's an embarrassment, but no one knows how to fix it. And the CEOs have always said, you know what, Jim, it can't happen. You see, it's a license agreement. Well, anything can happen. That's what we've learned about business. Anything can happen. Here's how you fix it. Get the execs to the airport. Start suing if you're taking pictures of 22, 30, 40 people in a dodgy line that's of a store that's understaffed. What a disaster. Someone needs to own that disaster. If you sue that licensor, at least you'll know that you're on our side and not their side. It is a little simpler than people think. Just get the right darn lawyers. So I'm pretty convinced that Luxman was the wrong man for the job. Nichol could be the opposite. When he came to Chipotle, he had to deal with the ghosts of the past, including some serious food safety issues. Got the chain in big trouble. First thing he did was get together with his employees and find out who they were and what they needed. He made sure that the best were promoted from within, and he straightened out a lot of the scheduling issues that had caused some grumbling. He did everything he could to get customers in and out as quickly as possible while making sure that the food is as tasty as possible. Brian's a master of that process, and process is precisely what Starbucks needs, especially in the afternoon when the stores are overpacked with people seeking cold drinks and no one seems to know what to do at all. Starbucks seems to lack process entirely. Starbucks went down the rabbit hole of innovation that its baristas couldn't handle. Too many new drinks, no idea how to make them. The old CEO was doubling down on new drinks when the baristas were still reeling from the old ones. No wonder there were labor problems. Brian, on the other hand, is mindful of how hard it is to roll out new things. He limited them at Chipotle. You never knew when things were going to leave the menu, which makes me it's kind of a treasure hunt now. He's exactly what Starbucks needs. I checked in with founder Howard Schultz today to get his view, knowing that Luxman no longer had Howard's buy-in at the end. Bad place to be, by the way. He told me, and I'm going to quote, "This is a great day for Starbucks. Brian is one of one." He then went on to say that there is, quote, "no one better to rejuvenate the company and the Starbucks brand than him. Our partners will embrace him," end quote. Howard was effusive about the move today. Quote, "The market's reaction is consistent with the concerns I had, and this is the solution I had hoped for," end quote. Something that makes me think Howard might have been pretty active in the changing of the guard. I have high hopes for Brian myself, but Howard's are even higher. Quote, "It's a new day," he told me. Quote, "Brian will restore trust with our people, rejuvenate the brand, fix operations, improve the customer experience, and create shareholder value." The latter one he sure did. Now, there are some things that Brian should consider if he wants to shake things up. First, maybe move the company where he works, Newport Beach, and out of Seattle to show that it's a truly new time for Starbucks. That's something he did 3 months into a CEO job at the then Denver-based Chipotle. Second, refresh the board of directors. Go with people who have expertise in the tech issues that are hurting their throughput. Finally, take your time. You're living right now with the hand that they've given you. The money you make, and you know what? I'll take the over in wagering that he has a potential $600 million 5-year deal, will not immunize you against criticism. And I think that after the stock's breathtaking run today, the long knives will now be out for you. So be careful. The bottom line. Brian Nichol is the key to a new Starbucks, one that can reclaim its old mantle as the third place. You just need to know that this turnaround can't happen overnight. But I'm telling you, it's going to happen. I feel like taking some calls. I would like to go to Labanat in New York. Labanat.
Hi, how are you, Jimmy?
I couldn't be better. How about you?
Good. Thank you. I love to be in your show. I love your show.
Thank you.
And I wanted to ask you about Amazon.
Sure. Okay, so just the other day, I issued an alert that we were buying more Amazon, now up nicely on it. And the reason I did that, just so you know, is that I've gone over the Amazon quarter 9 ways to Sunday. It was not a horrible quarter. They were being a little conservative about the spend of the retail customer. Everything else was great. And I think we're going to look back and say Amazon withstood that level of the 160, 164, and it's been going up. And I think that Amazon is a buy. Attend my meeting tomorrow at noon, the Investing Club, and you'll hear more. If you're not in the club, what's with you? Anyway, I feel positive this was the right move for Starbucks, and the turnaround will happen. We own Starbucks for the trust. We're not knuckleheads. On Man Money tonight, after a strong showing at Ellipsis, is one holding on the right foot. I've got the post-earnings exclusive. Then I think one sector you need to really be in as we look ahead to the Fed rate cut. Well, you know what? I'll reveal it in the names you should be watching. And is the pet spending thesis still enough to keep stock like Zoetis, ZTS climbing? I'm talking with the company CEO, so I want you to stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
look at On Holding Run. The popular Swiss sneaker company reported this morning. And while the headline numbers look a little mixed, setting the stock down as much as 15% in pre-market trading, once the conference call got rolling, it soared higher, finishing the day up 4%. Makes sense. On Holding is unique in that their Asia-Pacific business is on fire, up 78%, and they're not getting any pushback on pricing. Consumers don't want to pay full price for anything right now, but they'll happily pay full price for the On's running shoes. And apparel, only 5% of sales, is performing magnificently. I think it could double. This heavily shorted stock feels unstoppable to me, but don't take it from me. Earlier today, we got a chance to speak with Martin Hoffman. He's the co-CEO and CFO of On Holding. That's O-N-O-N. Take a look. Martin, welcome back to Mad Money.
Thanks for having me again. Super exciting.
Exceptional quarter. Done even with some difficulties in a fulfillment center here that I'm sure are now ironed out. How could you put up such phenomenal numbers?
Yeah, so we started the year now with 2 record quarters with increasing profitability. Last year, we communicated our aspiration to double our sales over the course of 3 years. And I think we have proven now that we are executing on that. And at the same time, we're just coming back from Paris, and really what our team was able to putting off there in terms of big brand moments, that was really amazing.
Now, innovation, always been your hallmark. I have not seen light spray. When can I get my hands on it?
Well, you should have come to Paris and see that robot at work. So we produce shoes on a daily basis. It's a revolution to the industry. It's the ability to create new designs, new levels of performance, to automate how shoes are made, and then reduce the CO2 footprint and bring us closer to circularity. So this is a big innovation story that our team has built over the last 5 years, and we are now starting to scale that. But we are still at the very beginning.
Okay, when I listen to you, I think of a once great company that was doing innovation after innovation after innovation in a true shoe dog-like fashion. Now they have they have a lot more revenues than you guys. But am I right in thinking that you believe you could one day challenge Nike for innovation, for quality, for all sorts of lifestyles and sports?
Well, first, let's dream about the next 2-3 years. And I think we have a lot of things to do there. We want to grow apparel, we want to grow retail, we want to grow China. And I think we are off to a good start there. But things like light spray are a look into that wider future. And I think it allows us to create unique products and innovation stories also in the long term.
I totally agree with you. Now, I'm giving you a little hard time just because I'm amazed at your innovation. And I'm amazed that everybody I know has switched from Nike to On. I'm going to tell you why. I hear one reason that I was asked. Many people told me to ask you this. If you had a head-to-head competition in terms of how long a shoe lasts, and I'm not talking about like the little part at the front that opens up. I'm talking about the spring that you have. Have you done any work to show you that that an On shoe lasts a lot longer than a lot of others?
I think our shoes last as long as basically the shoes from the industry last. I mean, we are a premium brand, so we pay a lot of attention to quality and premiumness, but then also to performance. And we certainly invest a lot of effort into maintaining that together with our partners also on the factory side.
All right, so I want to talk about your DTC and your unbelievably good interaction via computer, artificial intelligence, I believe. So yesterday I go in to your bot, to your site, and I say, listen, I used to get stones and pebbles in my shoes, On shoes, but I don't anymore. And my wife no longer complains that I have pebbles, that something happened. Sure enough, I put it in. She goes, oh, the old pebble story. Yeah, I know. Well, believe me, we've looked at it, and we've changed some things. Who came up with the idea of conversational, intelligent AI? Unless I really was speaking to a human.
Yeah, so I can't say anymore. You need to run faster to get the stones off the sole. Nice. We are continuously innovating, improving, and of course also making the shoes Specific to the different use cases, I think we have an amazing lineup of trail running shoes now that are specifically made for the trails. At the same time, we conquered the tennis courts around the world with the Roger lineup. We just started into training, which is an amazing partnership with Zendaya. And then we continue to win in running.
Well, I feel embarrassed. I wear my Rogers playing pickle, and I'm not that good, but I would never wear any other shoe on the pickle course other than yours. Now, I do want to know about apparel. It's small. It's 4%, but it's got momentum that tells me to get to 10% might not be that hard.
Yeah, we are very happy about this. So we clearly invested a lot in the past years into our team, into the product, and that product is hitting the market. And it's doing very well. We see around 15 to 25% share coming from apparel sales in our own retail stores. Our e-com environment is very strong with our app showing similar share of sales from apparel. I think our wholesale partners are buying into the new products. So yes, the 10% is a first step where we want to bring apparel. But to what we exchanged earlier, let's continue to dream from there.
Okay, one last question. I did get up to see what would happen when your stock traded a little early, but that's all right. And initially went up, which I thought was right. And then it suddenly went down, and it looked like shorts were pushing it down, to be honest, because you beat, but you did not raise. And then, of course, people came to their senses and realized it was a good quarter. But do you think things like that? I mean, you beat it, but you want to be conservative. You don't know what's going on with the DTC. Or are you really worried about the holiday season?
No, as you mentioned in the past, in the beginning, we would have been able to show even stronger growth, but our warehouse shows some capacity constraints on delivery. Which I think is normal in the scale-up phase that we are in, and I think our team is doing an amazing job to work around this. But that's visible in the numbers. At the same time, we restated or reiterated our guidance for the full year. We want to grow 30% on a constant currency basis. We prove we have a strong gross profit margin. We are significantly increasing our profitability, I think. The brand heat that we created during the last months gives us a lot of confidence then also in the long term.
I couldn't agree more. I think that you're in a remarkable moment where you have the best product and you're going to change the industry. I really appreciate your coming on Mad Money, Martin Hoffman, co-CEO and CFO on Holding. It is always a pleasure to have you on Mad Money.
Likewise. Thank you.
Thank you. Okay, Mad Money will be back after a moment.
Coming up, can heavy machinery light up your portfolio? A top-down look at the industrials. Next.
It would be, I'd be remiss to not call this a tricky moment for the market. See, the economy's slowing. Commodity prices are coming down. And many classic cyclical stocks have been struggling. All signs of the need for a rate cut. People are suddenly much more worried about a slowdown or even a recession. But on the other hand, we're also waiting eagerly for the Federal Reserve to cut interest rates and bolster the economy. The worse the data gets right now at this moment, the higher the probability that the Fed takes action. And when the Fed starts cutting rates, it's the economically sensitive cyclical stocks, which have been punished and are being punished, that win. At this point in the business cycle, where we're torn. We're torn between worrying about the economy and salivating over the prospect of lower rates. You absolutely need some cyclical exposure right here, but it pays to be selective with your picks. You know why I've been thinking about this? Because I think a lot of stocks don't fit the pattern. So why do I do this? Let me give you 5 industrials that I think are still beating the market this year because they're no longer pure smokestack stocks. They've given investors new reason to own them, though, in a changing world. I like these, and it solves a lot of the dilemma for me about what to recommend to you right before we have to cut. First up is Cummins. We had them on very recently. This is best known as a maker of truck engines. If Cummins were still a pure play on trucks, no desire. Trouble right now. After 2+ years of freight recession, truckers aren't exactly flush with cash. In the first half of the year, sales of Class 8, that's big guys, trucks were down more than 16%. That's rather remarkable versus the same 6 months in 2023. That's why they're calling it a freight recession. But Cummins actually hit a new all-time high earlier this month because it's no longer the Cummins of old. For starters, these guys have deftly managed the energy transition, developing lower carbon solutions that work right out of the gate, like natural gas-powered engine platforms, as well as working on zero carbon stuff for the future for electric and hydrogen engines. Now, in May, Cummins held an analyst day where they walked back some of their long-term targets for the zero carbon business, while also raising the outlook for their core internal combustion business, which was more than enough to offset the damage. Now, I think that they've been smart about working on green engines without abandoning the traditional mainstays that run on gas or diesel. More importantly, Cummins has a thriving power systems business where they make generators and commercial power systems for buildings, including, yes, data centers, which are all being built all over the place. Even if truck sales have slowed, the data centers on fire. These are backup power systems. Remember, data centers can't afford to go offline during a power outage. When Cummins reported earlier this month, they delivered much higher than expected earnings, and power systems accounted for roughly 2/3 of that beat. I was shocked at that. I just didn't think it was that big. Now, we spoke to CEO Jennifer Rumsey on August 1 on Mad Money, and she explained that the data centers become a key source of growth for Cummins. Of course, after roaring that day, the stock sold off the next week as the market turned on the industrials. But that just means you're getting an incredible quarter for free. Now, let's talk about a company that has changed its identity many times, but I really like the way it looks now. Let's talk about Dover, which used to be a classic metal bender, just like a textbook smokestack stock, frankly. In recent years, though, the company's transformed itself, become more secular, less cyclical, which is why we now own this one for the Charitable Trust. I'm proud of this one. I think it's going to have a big run. The new Dover now sells into some of the best secular growth themes of our era. Think lower emissions refrigeration and cooling systems. Think heat exchangers and thermal connectors. The data centers, I know, a lot on that, used to keep temperature down. Think pumps and processors for the life sciences industry. Even though this company's reported 2 straight beat and raise quarters, well, the stock's basically been trading sideways since March, as it's still seen its traditional smokestack name. Even though they reshuffling the portfolio again, they just got rid of some waste refuse division. I think the market's underestimating Dover, hence why we've been building a position in it for the Charitable Trust. I think it's going to have to be discovered over time. Third is another Charitable Trust name, ETN, Eaton, which is a major player in electrical power management systems, as well as making components for autos and aerospace. These guys benefit as the government makes major investments in the electric grid, which it cannot handle all the power that needs to be produced right now. You also need their equipment to move manufacturing back to the United States. That's a mega trend. And of course, these power management systems are essential for, yes, the data center. Eaton's gear can give customers visibility into their energy usage at all times. Now, while the stock has rallied hard at the beginning of the year, Eaton has stalled out big time since the spring, just like Dover, because of worries about a slowing economy. I think you're getting a good chance to buy it before the next big run. And boy, this one is down a huge amount from the high. Painful for the trust, good for you. Fourth, how about Hubbell? Now, I brought this one up a month ago. It's a company that makes equipment for utilities and large commercial users of electricity. As I explained last month, Hubbell's a play on the modernization of the electrical grid and the overall need for more power, both to support new manufacturing, especially for the data centers, again, by artificial intelligence. Too much data center, what can I tell you? That's the hottest segment. It's also a renewable energy play because Hubbell helps get power from solar panels or wind farms to the grid. That's very good. I like Hubbell, too. Now, at the end of July, 2 weeks after I recommended it, the company reported a solid quarter with a strong full-year earnings forecast. Even if the sales forecast was less optimistic, that was enough to send the stock up nearly 8% over the next 2 days. But then the market melted down, and that Hubbell gave back most of these gains. Again, so you're getting that latest quarter almost for free in a secular growth story. Now, I've got one last new one that I've been looking at. It's been driving me crazy. I watch it. I love Cleveland. I love Ohio. I love. It's called Parker Hannifin, PH. That is currently up 24% for the year. Now, this is a company. What a quarter they were. Oh, my God. It's just like stars flying out of it. Here's a company that makes motion and control systems, along with filtration products, fluid connectors, and engineered equipment for aerospace and defense, industrial equipment, vehicles, heating, ventilation, and air conditioning, all the things that you probably don't want to do, but I don't care because it's really making a lot of money. Like the other companies I've mentioned tonight, Parker Hannifin has shaken up its portfolio in order to double down on secular growth mega trends like aerospace, infrastructure, clean energy, semiconductor manufacturing, and again, the data center. Last week, Parker Hannifin reported what may be the best quarter of any industrial company I follow. They posted 3% organic revenue growth. Wall Street was only looking for 0.3, pairing that with a 55-cent earnings beat off a $6.22 basis. Better yet, management gave a strong forecast for the new fiscal year. They're now in 2025, and 2025 is looking pretty darn good. That's why the stock jumped more than 10% last Thursday. I think it's got more room to run because there's just not a lot of shares out there. I mean, it's kind of like there's like nothing. If you try to buy it up like 100 points, that's not a lot of stock for sale. Let me give you the bottom line and what I think is one of the more exciting pieces, because this is where the action is at this point in the federal rate cut. Right here in this tricky market, people are giving up on the industrials, exactly the moment where they should be buying them because the rate cuts are on the way. Does anyone else have the textbook besides me? That's why I recommend the new industrials that have pivoted to powerful sectoral themes. I know I could have included CAP, but I've beaten that horse to death. But it's easier to stick with these when everyone else is panicking. And that's Cummins. We write these down: CMI, Dover, Eaton, Hubbell, and then Parker Hannafin. They all benefit once the Fed starts cutting. In the meantime, they're holding up much better than the other smokestack names because they have gone secular. All right, you know what I'm going to do? I'm going to start with Stafford, who happens to be from California. Stafford.
Hey, Jim, how you doing today?
I am doing well. How about you?
Good, thanks. I wanted to get your thoughts on AutoZone. I know they buy back a lot of stock.
Well, the problem is that's kind of all that they're doing right now. They don't have the old mojo. I will admit that they lack that serious mojo per share number that I always like to have. But I will say this. They have hung in here pretty darn well, and I think they continue to buy back stock. And I would still, even at $3,155, I would still buy the stock of AutoZone. I've been right for maybe 3,000 points. I ain't going away. All right, let's go to Mike in Georgia. Mike.
Jim, I'm 81 and wanting to increase my dividends. Would Energy Transfer, ET, be a safe investment?
ET has done a very good job. It's Kelsey Warren. I used to be critical of him. He went on a big buying binge. But I'll tell you, I've been very impressed, very, very impressed with ET. ET, buy home. People are giving up on the industrials at exactly the moment where the textbook, which is in my head, by the way, but also is available in the book Real Money, exactly when you're supposed to be buying them, not selling them. But that's because people don't know enough, because there's very little history that is taught about the stock market. There's much more mad money ahead, though. Could an investment in Zoetis, ZTS, have you barking up the right tree? I've got the company CEO after the earnings. Then it's mad money, not mad politics. But tonight I'm revealing how to prepare your portfolio for November's presidential election. And by the way, this will not be the first time. And of course, all your calls rapid fire in tonight's data center edition of the lightning round. So stay with Cramer. One of my absolute favorite themes, the humanization of pets, is back. For years, this was a powerful theme that could make you big money in the right pet stocks. But in the post-COVID era, well, it seemed like it was fading away. But in recent months, it's come right back. Pets are being treated like as members of the family again, which brings me to Zoetis, a heavy hitter in the animal health space. If you have animals, you know them. Last Tuesday, Zoetis reported a healthy top and bottom line beat driven by excellent results from the U.S. companion animal business, up 13%, double digit year over year. Stock rallied 6% in response and has kept climbing over the past week, as it should. But does the move have legs? Let's check in with Kristen Peck, the reliable CEO of Zoetis. Ms. Peck, welcome back to Mad Money.
It is great to be here, especially after such an outstanding quarter. So thanks for having me.
Oh, it was a fantastic quarter and a great set of numbers. And I just, if you could give me a sense of how much of what you're riding is the old wave and how much of it's just innovation you guys have that will take you self-help further.
Well, I think the quarter and I think our year has really been driven by two things. One, outstanding innovation and bringing, new products to market, but also just incredible execution. If you look at the last 11 years, we've had a compound annual growth rate of 8% year in, year out. And that's a healthy, resilient animal health market, as you talk about often, that grows 4 to 6. But it's our innovation that really differentiates us.
Now, the innovation is something that I believe the younger, more affluent pet owners really get. They are smart. They can compare. They can go on Google. They go on chat, whatever. They seem to understand the kind of stuff you're doing.
Yeah, the majority of pet owners today are young and they are affluent, and they see their pets as important members of their family, and therefore they want to give them the best care. And that's why we can bring products such as monoclonal antibodies for osteoarthritis pain like Librela and Silencia to the market in a self-pay market, and it's been phenomenal.
Well, let's talk about that. I mean, Librela got, well, I know I'm a cat person too, but Librela got a lot more mentions than I ever thought. So why don't you tell people why you weighted that in your discussion? It was really important.
Yeah, Librela grew 142% in Q2, so it was a phenomenal performance. And really, it has to do with launching a product that's safe and efficacious, that's really transforming osteoarthritis for dogs across the world. And as you look at for cat owners, there's Silencia, which grew 60% in the quarter. And we're really proud of these products. And most importantly, the impact they're having on animals and their families who now get to take their dogs for a walk or let them come upstairs.
But do you think that the vets all know about these products, or are you supposed to ask for them when you bring your animal in?
Well, you, of course, should always ask for them,
Right.
but we're really proud of the penetration we've been able to get with Librela.
Okay.
It is the fastest penetrated product in the history of Zoetis. It's got an 80% penetration right now in U.S. vet clinics.
That's fabulous.
With an 86% reorder rate. So we're really pleased with that in the quarter.
Okay, we all use the Simparica Trio, and I presume it's still doing incredibly well. We got 19% growth.
Yep. Well, if you look at the Simparica franchise overall, we've got about 22% growth in the franchise, and that's a product that's been on the market since 2020. So as you talk about it, we're able to still deliver more than double-digit growth, 22% growth in a franchise that's existed for many, many years because it's chewable, it's easy to use, and we're really continuing to grow that market. And we're really excited, to your point on the future growth there. 37% of puppies are going on Simparica Trio. And once you start a product, you're likely not going to ever stop that one.
No, absolutely not. No, we just had Apoquel on, again, something that I think if you're a pet owner, you're quite familiar with. But there's some potential competitors for the first time. Elanco's got something. They expect approval in September. I know that this fear of someone coming in drove the stock down. Overreaction?
I think so. As you look at the performance in the second quarter, we had 18% growth across our derm franchise, which has been on the market for over 11 years.
It was introduced on our show.
Yeah, and I think we have got two opportunities there. One, we continue to drive, compliance, but we also can grow the market. We think there's still 11 million dogs in the U.S. who can still go on an important dermatology treatments like Apoquel Chew, or Cytopoint, our monoclonal antibody.
What are these people doing right now with their dogs? Are they just letting them suffer?
So 8 million people have a dog who has, a dermatologic condition, but they're either maybe using shampoos or trying diets and things like that.
Well, that's what we did before Apoquel.
About 3 million of them
shampoo.
might be on steroids.
You're right.
And as you look at the side effects there, we really think, going on Apoquel or Cytopoint can make such a difference in their lives.
Okay, so I want to know a couple things, and this is not in any of the conference calls or anything, but we lost a dog to bloat. Any chance that you might work on something bloat?
It's not one of our core areas right now. We're a little more focused on, as you know.
Well, that's a problem. We have niche. But we care so much about them. Any digestive that you're working on?
Yeah, we're looking at digestive in sort of the broader category of sort of diabetes, obesity, which I know we talk a lot about. Yes,
that's what I care about.
Yes.
So you're working on that. Okay, that's terrific. Then the last thing, can we ever find things that would vaccinate our dog? I have I don't want to call him dumb because that'd be mean. His name is Tony, no. But he likes M&Ms. He likes Raisinets. Now, these kill him. I can't seem to get, is there any way we can immunize these dogs from doing silly things?
I think the same way kids will be kids, puppies will be puppies. If I can immunize my puppy Luna for a lot of things, trust me, I would. She gets into tons of trouble.
I'm just putting on my wish list because I respect what you've done.
I would say it's not what you feed your dog, but what it feeds itself, it's the problem.
There you go. Absolutely right. All right, that's Kristen Peck, CEO of Zoetis. This has been a stock we've recommended ever since the spinoff, ZTS, and we feel very strongly now that it's going higher. Mad Money's back after the break.
Coming up, hit us with your best shot. An electrified fast fire lightning round is next.
It is time. Time for the right quiz. Back for all the numbers. And then the lightning round is over. Are you ready, Ski Dad? The lightning round quiz. Hey, let's go to Roy in Pennsylvania. Roy.
Yeah. Hey, Jim, go Phils.
I love Phils.
Years on me. I, too, was a Penn Manor elementary kid.
Get
and I grew
out.
up on Preston Road.
No, come on. Were you there the day I was suspended falsely? No, I'm sorry.
What the? Were you a Cromwell or Stokesbury kid?
Preston Road. Man, I met him on. Well, what stock we got?
Okay. MLI, Muller Industries.
Whoa, I remember when Muller came out of the bankrupt steel company. It is a fantastic company. Never gets its due. Very plain vanilla copper products. Buy. Of course, a guy from Preston Road has 4 cents. At Penn Manor, I used to throw pencils into the roof and they would stick. And then I'd blame it on Doug. Okay, let's go to Trey in Texas. Trey.
Jim, I have to toss on my oven mitts these days before opening my brokerage app due to my shares of GoDaddy. They are burning hot, baby.
Send me some asbestos. They're absolutely right. That thing is a juggernaut. And one of the reasons is because it's very low multiple and it helps a lot of small businesses. I like it. Let's go to Lou in Pennsylvania. Lou.
Hi there. Booyah to ya, Curly.
In the old days, perhaps. But go ahead. I had red hair, by the way, when I was younger. Can you believe it? Red hair. What was that all about? Go ahead.
Why don't you grow it again?
All right, let me talk to who I don't even know who to talk to anymore. But go ahead.
With a lot of conflict from all over the world, from Ukraine to the Middle East, what do you think about this best-of-breed company called Lockheed Martin?
I think you buy Lockheed. I feel badly that I didn't buy it for the Charitable Trust because I like Takelet so much. I think you got a winner there. Hey, let's go to Jay in Connecticut. Jay.
Jim, big booyah to you from Westport.
From Westport. Oh, I had a summer house in Westport once. It was so much fun. I loved it. There was like this free beach that I used to go to. It was like Sherman something. I don't know. It wasn't bad. What's happening?
Sherwood Park. And
that was it.
Campo Beach. Yeah.
I did Campo too, but Sans Beer, which is like, that's French. Okay, so what else?
I've been a big follower of yours since the days at thestreet.com. You and I have to have a mutual acquaintance, but I'm not going to name drop. You got a busy schedule. You got a lot of people calling in. Here's the question. Dell Computer. You became very constructive when the
I have to be. Down here, it is too low. Betting against Michael Dell has never been like a really good idea, okay? I just find that betting against Michael Dell is just going to be a loser. You should be buying the stock. I need to go to Nick in Missouri. Nick.
Hey, Jim, it's Nick Peterson calling in from Kansas City, home of the Great Barbecue.
I forgot that. That's true. Arthur's. Do you think Arthur's is overplayed? Leslie Picker said don't use Arthur's. Go to another place.
Oh,
maybe
Arthur's
too much in barbecue.
Arthur Bryant.
Okay, there we go. All right, so what do you got for me? I gave you Arthur's. What do you got for me?
Yeah, so just want to hear your thoughts on Qualys. I think they've got great strategic partnerships with Mag 7.
This thing is bothering me. It keeps going lower, and yet other companies in the same industry, vulnerability management, are doing well. Let's find out. If there's something wrong here with Qualys, I am going to have to handle with my research team and figure out what to do. Let's go to Ronald in California. Ronald.
Hey, Jim. How are your family doing?
My family's okay. Thank you for asking. We're trying to figure out what to do this weekend. Maybe a little gardening, maybe a party, that kind of thing. How about you?
Great. I have first-time grandfather recently, so things are great.
Lucky dog. You're just a lucky person. Good for you.
I just opened up and put a chunk of money in the stock 29 from money I made from your advice.
Oh, thank you. Thank you. Attend the meeting tomorrow.
So anyway, the company I'm interested in is a smaller version of United Rentals. It has missed the last 2 quarters, but had a long string of making estimates. It only sells at a 10 PE, and it sports a 2.5% dividend. The company is H&E Equipment.
I like that mini. That's it. Look, it's a mini UNI. You're absolutely right, and I think there's room for it, and I would be a buyer of it. How about Brad in North Carolina? Brad.
Booyah, Jim.
Booyah.
Hey, thank you so much for taking my call, Jim. I'm getting older. I'm starting to think a lot about dividends, and I've been really liking Golub BDC. I didn't know if you could share any.
No, it's okay. You see, I don't really know what they own. It's one of those middle market plays that I get asked a lot about, and I've told people to avoid them for as long as this show's been on, and I've been very right, so I'm not going to deviate. Let's go to Jonathan in my old home state of Pennsylvania. Jonathan.
Booyah, Jim. How is my favorite investing club fellow Bucksmont, Pennsylvania native doing?
Oh, my, we got a lot of Suburban One people here, and I can't believe it. I mean, why doesn't Ed Breen call in? I think I beat Council Rock when I was there. What's up?
I'm a Council Rock alum. My good man, this morning to the club, you gave a great example of how bad reporting in the news impacted a well-known equity recently. I'm struggling to figure out the automobile industry dynamics and would love your take on the reportage there and what you would be looking for in the stock of Borg Warner. Thank you, Jim.
Okay, and thank you for mentioning that. I decided to take on someone. You're never supposed to take on the press, but I've had it. Borg Warner, look, auto business is bad, okay? They need a Fed rate cut, and then it'll go up, but not until then. I am sorry. And that, ladies and gentlemen, the conclusion of the Lightning Round.
The Lightning Round is sponsored by Charles Schwab. Coming up, election time means plenty of noise. But Cramer zeroes in on the signal. Next.
Finally, someone broke the silence. Finally, a top dog at a company admitted what seems so obvious. Business will not be the same under Trump as it would be under Vice President Harris. Most CEOs they're deathly afraid to admit that a change in the White House means anything. And I don't blame them for trying to steer clear politics. Wow. They talk about the long term, which presumes everything near term is pretty much irrelevant, including who's in the White House. They don't even acknowledge there's an election. However, Jonathan Gray, the president and COO of Blackstone, is secure enough that he's willing to go there. In an important interview this morning on Squawk on the Street, Gray said that they've done well under both Republicans and Democrats. He said shifts in developed markets are not as dramatic as shifts in developing markets, something he knows all too well from his own portfolio. The legal backdrop can move dramatically here, but only if White House and both houses of Congress are under the same party. Oh, and even then it only happens if the Supreme Court's willing to play ball. Nevertheless, Gray said liquefied natural gas could get a real lift if Trump wins, and renewables would do better under Harris. I know this seems obvious, if not soporific, but when the COO of Blackstone, with $1 trillion in asset management, decides what areas are worth investing in, he's making more than just a statement. He's assessing the risk that some major problems, like the Inflation Reduction Act, could be changed. He has to ask if the business still works when the other parties in power. This is something I've heard from very few executives because most of them would prefer not to make waves by discussing this stuff. I think the election will have a significant impact on the stock market, though, and I try to factor that into every stock. We only have one name that I'm worried about for the charitable trust. More on that when we convene the Investing Club monthly meeting tomorrow at noon. Long story short, I want to steer clear of any investment that will get whacked based on who wins in November. That said, Gray, who's a truly fantastic investor, had this to say for our audience. Take a look.
What I worry about as investors is they focus so much on the noise of the election, and it's those big mega trends we've been talking about. What's happening in digital, what's happening in life sciences, what's happening in the recovery in real estate, or what's happening geographically in certain markets. That, I think, is the long-term thing to focus on.
Megatrends like the data center, which Gary thinks will thrive regardless of who's president. Blackstone has a huge number of data centers through a holding called QTS, which they acquired 3 years ago. They have even more AI exposure through another business they financed called CoreWeave, which started as a crypto miner of all things and morphed into an outfit that acquires and aggregates NVIDIA GPUs, created high-power clusters whose computing power can then be leased to others. Business is incredibly robust. And by the way, that's a great sign for NVIDIA's future and helped increase the price of NVIDIA today. But let me make this point. There are very few things that President Trump and President Biden agree on, except perhaps the desire to block the Nippon Steel-U.S. Steel merger. That could end up benefiting Cleveland Cliffs, as it might be able to throw in a lowball bid that actually goes the distance. More importantly, we're now close enough to the election that you should probably avoid trying to bet on either outcome. It's become too close, not worth the risk. Again, a Trump administration and a Harris administration could play out quite differently for the stock market. But for the moment, that's all noise. Rather than searching for Trump stocks or Harris stocks, take Gary's advice and focus on the big themes that work either way. But be sure you know whether you are buying the stock of a company that feeds in the public trough, because you don't know which trough they will, in the end, pull away. I like to say there's always a bull market somewhere. I promise I'll find it just for you right here on Mad Money. I'm Jim Cramer. See you tomorrow.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC, NBC Universal, or their parent company or affiliates, and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Jim Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and or subsidiaries warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.